What if one oil company sold off one of its biggest business units, slashed debt by billions, broke production records, and still managed to raise its dividend, all in a single year? That's exactly what Occidental Petroleum just pulled off. And if you're watching OXY, you need to hear these 10 takeaways from their Q4 2025 earnings call right now. Coming in at number 10, Oxy completed the sale of OxyChem, its chemicals division, earlier this year. This was a deliberate strategic move that management described as the final step in a 10-year journey to build the best oil and gas portfolio in the industry. The sale brought in significant proceeds, helped slash principal debt down to around $15 billion, and allowed the company to sharpen its entire focus on high-margin, long-lasting oil and gas assets. At number 9, CEO Vicki Hollub gave a candid and thought-provoking macro outlook. She acknowledged that near-term oil prices may be driven up by geopolitical events, but cautioned those gains may not last. However, she sees a more structurally bullish case forming by 2027, driven by a collapse in industry-wide reserve replacement, which has fallen to below 25% globally. Simply put, the world isn't finding enough oil to replace what it's consuming, and Oxy believes it's uniquely positioned to benefit from that tightening. Number 8 is about Oxy's direct air capture technology. The company's Stratos facility is entering its final startup phase, with Phase 1 expected to go online in Q2 2026 and Phase 2 beginning commissioning in the same quarter. This carbon removal project is a key part of Oxy's long-term strategy around CO2, power, and midstream integration, and management views it as an important differentiator for resource recovery and long-term value creation. At number 7, Oxy announced an 8% increase to its quarterly dividend. This isn't just a feel-good gesture, it's backed by real structural improvements in cost and cash flow. The company's lower sustaining capital requirements, reduced debt load, and disciplined operations all contributed to management's confidence in growing the payout to shareholders. Number 6 is all about cost savings momentum. Oxy is targeting an additional $500 million in oil and gas cost savings in 2026, including roughly 7% lower well costs, 5% lower facility costs, and a 4% reduction in domestic operating expenses. This builds on the $2 billion in annual savings the team already achieved between 2023 and 2025, a remarkable track record of efficiency gains. Coming in at number 5, Oxy delivered a record annual production of 1.434 million barrels of oil equivalent per day in 2025, beating the top of its guidance range while spending $300 million less in oil and gas capital than originally planned. New wells also outperformed the industry by more than 10% on a 6-month cumulative oil per foot basis. That combination of more output for less money is exactly what investors want to see. Number 4 is the aggressive debt reduction story. Over the last 20 months, Oxy has repaid nearly $14 billion in debt. The newly announced $700 million tender offer brings principal debt to $14.3 billion, a reduction of over 40% since year-end 2024. With only about $450 million in maturities due over the next 4 years, the balance sheet looks dramatically healthier than it did at the time of the Crown Rock acquisition. At number 3, Oxy expects to improve free cash flow by more than $1.2 billion in 2026. That improvement is driven by $500 million in oil and gas operational savings, $400 million in midstream savings, including better crude transportation costs, and approximately $365 million in reduced interest expense. That's a powerful combination that supports both the dividend and further balance sheet improvement. Number 2 is the jaw-dropping resource base. Oxy's total resource base now stands at 16.5 billion barrels of oil equivalent, providing over 30 years of low-cost development runway. Critically, 84% of that resource breaks even below $50 per barrel, and the average break-even across the portfolio sits around $38. That gives Oxy enormous resilience against oil price volatility and a long runway for value creation well into the future. And the number 1 takeaway: Oxy is entering 2026 with a leaner, more efficient capital plan that still delivers production growth. Total capital spending is expected to range between $5.5 and $5.9 billion, $550 million less than 2025, yet production is still expected to grow roughly 1% to approximately 1.45 million barrels of oil equivalent per day. Lower spend, higher output, stronger balance sheet, and a bigger dividend. If Oxy can execute on this plan, 2026 could be a defining year for the company and its shareholders. Drop your thoughts on OXY in the comments below, and don't forget to subscribe for more earnings analysis from Earnings Central.